We are an alternatives only asset manager. We've been around for 50 plus years. We actually started in the hedge fund space. Today at Grosvenor, we manage $82 billion of capital. About 23 of that is on the hedge fund side, and that is really the legacy business. Grosvenor, we are trying to build track records and proof of concept across a number of different thematic investing, impact, or sustainable strategies that show that you don't have to choose between performance and purpose. You can actually do both, and it can be complementary if designed in the right way. That core DNA of Grosvenor, which was around customization, we've put over $10 billion with underrepresented managers in private equity. In 2003, before the term ESG even really existed, we were doing inclusive finance programs. We made our first renewables investment back in 2007. In underrepresented managers, our track record actually is a couple hundred basis points better than our broad private equity manager track record, which is kind of unbelievable based on the scale of what we're talking about.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. John, it's great to meet you. Thanks for coming on with me today.
Scott, thanks for having me. I'm really excited to be here today.
Before we dive into things, I always want to understand the human side of your story. And your story starts in New York City. And it seems that life threw you a real curveball when you were only 5 years old. So tell me what happened.
As you said, I grew up in Manhattan. I went to private school and was fortunate to be surrounded by opportunity from a pretty early age. I know that's not everyone's experience, particularly in our industry. And so it's something I never take for granted. But living in that environment gave me a real front row seat to how wealth is created and managed. And I think it set a foundation that I could see that ultimately this creation of wealth can either uphold the status quo or be a force for change. And so it would take many years before I got to sustainable investing. That was an important thing. Luckily, and good and bad, I had two things that always, I think, shaped me to who I am today and really kept me grounded. So the first, before we even talk about the event that you mentioned when I was 5, is my father's upbringing and values. So unlike how I grew up, my father grew up in a low-income community in the Bronx, New York. He didn't have a lot of financial resources. My grandfather was a photographer. My grandmother was a stay-at-home mom. In order to make money, he sold newspapers. He attended public school, went to DeWitt Clinton, and then couldn't afford to really go to the colleges that he wanted to. He always wanted to go to Cornell, but ultimately ended up at City College because it was free. Luckily for him, his break came because he was fortunate enough to earn a partial scholarship to NYU Law School. And then from there, he really was able to build a career off of that. He was a law clerk. He worked at a large law firm for 6 years, but he knew pretty quickly that he wouldn't be happy. And that wasn't the life that he wanted to work for. He really wanted to work more with people and less for a major institution. And so he partnered with a law school roommate to start a firm over 30 years ago and led it and grew it and was the managing partner. And so I saw that success from his background, but he never lost that humble mindset or connection to where he came from. And so it was very much grounded in me that even as the firm became more successful and grew, he, never made us feel like we were entitled to the privilege that surrounded us. For instance, I would leave the lights on in my bedroom and he would come and turn it off to save money. So he always kind of lived that life, even as he was financially doing better. The second thing, which you mentioned, is that I unfortunately lost my mother to cancer when I was 5 years old. As you can imagine, that kind of loss leaves a lifelong imprint and really shaped how I see the world and who I am today. First off, I think, again, tying back to what we all do, it created a lifelong connection to health and cancer research and advocacy. Over my life, I've worked with groups like the Ovarian Cancer Research Fund, the Vassar Institute at University of Pennsylvania, to honor her memory and try to make a difference and really, get rid of this disease, which is such a challenge out there. But I think over the years, what I've also realized is that this experience showed me that even for people who are presented with extremely negative, tough life circumstances, if you have the right combination of support, mentorship, and some luck, you can create a different outcome and a different story. Where that story went for me turned a lot brighter. A few years later, my father remarried, and my sister and I were welcomed with open arms into the life of a woman and two daughters who had also recently lost their husband and father. And we became effectively the real life Brady Bunch. We were a blended family. It took some time. It was beautifully chaotic, but it formed a really unexpectedly cohesive, supportive family that I'm extremely close to this day. From day one, I never called her my stepmother. I always called her mom. My sisters, I never saw differently. It wasn't, the word step wasn't how we felt or how we lived. It was only a technical kind of description. And so I think through that chapter, it taught me a lot about resilience, how life rarely follows a straight line, how careers, are unpredictable. And also, again, how you can kind of change the narrative if you're fortunate enough to have support and people around you that can do that. It took many years, though, before any of this translated into a sustainable or impact investing career. My story is really one that was built as a traditional buy-side direct investor for 10 plus years before the world of sustainability really came into my life. Taking a step back, I thought for a while I would become a lawyer like my father. I had a love for baseball. And so when I was at the University of Pennsylvania studying history, I explored different career paths. I worked at ABC News one summer, and then I actually had the chance to interview with the New York Mets for a job in baseball operations, which has always been a dream of mine. Unfortunately, I didn't land that job, but it led me to an unexpected door working in finance. Spent a summer working at a venture capital firm, and then was fortunate enough to get a summer internship at Bear Stearns in investment banking. And so that was really the foundational backing of my investing career, which then was built on for 10 plus years at Davidson Kempner, then at Sheffield Asset Management in Chicago. I also, and we can talk more about it, had experiences in my investing career that I think now upon reflection also gave me some shaping to my thinking. For instance, at Bear Stearns, I covered gaming and logic right before the great financial crisis. I worked on some of the most aggressive leverage deals of hotels using commercial backed mortgages. I knew they were pushing the needle to 9, 10, 11 times leverage to make the math work. At the time, I was a young analyst, so I obviously couldn't drive that. But in reflection, I think I had a front row seat basically to excess and not really sustainable investing. And so I think that played a role in how I developed as an investor.
I wanted to back up. You went to UPenn and studied diplomatic history. That's pretty specific.
It was a mixture of political science and history. I always had a love of kind of history, but also in terms of kind of political situations, geopolitics, and Penn had a really unique program where you could mix those two. And so that was why it was called diplomatic history. And so I liked that it was a blending of learning about the past, but also very much focused on today's geopolitical world and how the history, kind of related to the present. And so it was a really great opportunity to do that.
Did you really want to get this job in baseball operations, the Mets of all teams?
I grew up in Manhattan being a Mets fan, which was rare at the time. They were not very good for a long period of time. Most of my friends in grade school were Yankees fans, winning championships, spending money. It was very pre the Steve Cohen Mets that we see today. I always had a love for baseball. I played baseball in high school. And I had this idea that in my career, I could turn it into a career doing baseball operations, try and be a general manager. I still fantasize about it at times, but, my path went in a very different direction.
There's some irony here. You had this great idea to work for the Mets. And just like the Mets, it started out great and then it just fell apart hard at the end. Huh?
I've had a couple of those instances in my career. I've been very fortunate and lucky to kind of move up in a number of places, but I've also run into things like the GFC that led to different events, changing my path at different times.
at Bear Stearns, you landed in investment banking and you were an analyst there. What were you thinking when you took that job at that point?
When I first was introduced to finance, I obviously came at it from a very different way than most investment banking summer analysts. I was competing for those jobs mostly with Wharton undergrads who knew from day one that was kind of the preeminent place to be, at least at the time, to start your career. When I interned at this venture capital firm after not getting the job in baseball for a summer, I knew nothing. I started to hear words like EBITDA. I started to learn things, but I knew that, I needed a lot of kind of teaching before I could really be effective in a career. And so the manager at the time at this venture firm, when the summer ended, he said, if you really like finance, investment banking is the best place to learn. You will do, a 2-year analyst program that is the equivalent to 4 years of work because of the amount of time that you spend there. But it's the broadest kind of foundational way to learn finance and learn how to properly underwrite, invest in companies. And so I kind of threw my head into that and was fortunate enough, again, to get the job at Bear Stearns, which was highly competitive. And there were many nights that I did not like doing that job, but I still tell many people it's a phenomenal kind of place to start, whether you want to be in private equity, hedge funds, mutual funds, sell-side research. I mean, it's just a great wide base of learning about companies, transactions, the market.
You got out of Bear in 2007 and then moved to Davidson Kempner Capital Management as an investment associate in an event-driven equities fund. That's quite a shift from investment banking to hedge fund investing. Had you already decided you wanted to be on the buy side?
So the natural path for most people coming out of banking at the time was you went into private equity. I had just, again, a love for markets and particularly like global events as well as stocks. And I liked the speed and the pace versus what private equity looked like, but I didn't really know it. And it was actually the first interview that a headhunter sent me on. I was a little behind the game because most people had already gotten private equity jobs and I didn't want to play in that world. But I went to Davidson Kempner, which at the time was an $8 billion fund. It was focused on distressed debt and merger arbitrage, and they were looking to start a brand new strategy. So I was the first person hired for this dedicated new strategy, which I thought was really exciting. And I thought it was a great opportunity. And to this day, think very highly of the firm. The managing partner of the firm today is the person who I worked for, Tony Osloff. And, I have many kind of friends and relationships still back there. So it was a great place to kind of start.
Event-driven investing requires pretty specific mindset. How did you develop the ability to see opportunities in market dislocations that others might miss?
So I was really fortunate because I sat on the merger arbitrage desk, which obviously is all around M&A and events. And so I got to learn firsthand from, Zach Altshuler, who runs that business, and a number of other people watching what they did. And then the portfolio managers of my strategy actually came from the distressed debt world. And so they were really credit investors, excellent at underwriting risk, but also around restructurings and other types of events. And so I got to work with both sides of professionals who had a lot of experience in those worlds. Equities was a little bit of a different thing for the distressed debt professionals. Investing for a longer term frame was different than the merger arb professionals. So everyone was doing something a little bit different, but there was a lot of great foundational kind of knowledge and experience that I was able to absorb in that seat.
Then about 2 years after you joined Davidson Kempner, you made another move to Sheffield Asset Management as a partner and senior investment professional. So what was going on at Sheffield that attracted you, and what were you doing there?
My wife now was from Chicago. We were living in New York. We had met at Penn. And so we explored potentially moving to Chicago. And so I was introduced to the two managing partners at Sheffield at the time. Sheffield was a $400 million fund at that point and had really done a great job of building to what they were without really hiring a ton of people with traditional kind of experience. And so coming out of the GFC, there was an opportunity for them to go get talent that probably they maybe weren't able to get normally. And so I kind of fit that profile. And so what was really interesting about Sheffield was that their claim to fame at the time was that David Einhorn from Greenlight had put them into, he has a fund of funds called Greenlight Masters that it manages all of his money or most of his money. And it's meant to be for smaller emerging funds that do strategies that he thinks replicate what he was really good at when building Greenlight. And so Sheffield was branded as one of those funds. And so there was a lot of kind of marketing allure of being what people think of as Tiger Cubs. This was almost like a Greenlight Cub at the time. So I was really intrigued. I liked the opportunity set. It was a small firm. I believed that if I went as an investment professional, we could really grow the firm. And I was there for 8 years. I'm a partner. It was a great experience. We grew it to over $1 billion and learned a lot and kept developing at that point.
That was a good chunk of time. And then you joined Grosvenor in 2017. And originally you were in strategy and corporate development. Tell me, how that move came about and what was the attraction going there?
So after doing over 10 years of being a direct investor, I had found at Sheffield that I also enjoyed doing other business building activities. So I would say I was an investor, that was my day job. And then my night job was a lot of other things. And so as I grew and became a partner, I helped with capital raising. I brought in a large account and managed that for us. I did, a lot of our hiring. I did a lot of our vendor management. I did a lot of strategic kind of thinking and conversations. Going back to my father, who had been the managing partner at a law firm and really built that, I realized that different than many of my peers, my goal in life was not just to be a portfolio manager and just read 10Ks. I like doing that. I think I'm good at it. I also recognized that I had a lot of other passions and skills. And so I wanted to broaden out kind of my career path. And so when I was approached by Michael Sachs at Grosvenor, I was intrigued by this opportunity to step a little bit back from being a direct investor and directly investing in the market and really be part of helping to run and build Grosvenor, which at the time, had been very successful, but was continuing to evolve. And Michael really used the strategy and corporate development group as an incubator of kind of versatile talent. I worked very closely with him and John Levin, our president, doing a number of different kind of business building activities, from acquisitions to new team hires to helping to reformulate some of our internal strategies. And then I was basically approached about 6 months in. We had hired a new chief operating officer, Francis Edahen, who is now a partner at Goldman, who I'm very close with. And Francis was managing, 8 departments and 350 people around the world. He had come from Exelon where he was a treasurer. And I think that there was an opportunity for him to have someone help him kind of manage that. And so I was approached by Francis and John, and they said, if you want to be a really well-rounded kind of leader one day, learning not only investing, but also the back of the house, the operations of a business can be really valuable. So I served as our Deputy COO for a few years, helping manage everything from finance and accounting to legal to compliance to technology to marketing, and really rolled up my sleeves in partnership with Francis to support his efforts to really keep creating efficiencies on that side of the business. But while I was doing that, where my story kind of shifts back is that I was always kind of spending some time still doing the strategy and corporate development stuff with Michael and John. One of the big things I did was I helped launch our first permanent capital vehicle in Australia, which is a listed private equity vehicle. It's on the ASX. It's PE1 is the ticker. And that was a very big initiative through a joint venture with a firm called Pengana that I helped lead. And so I got very close with our CIO, Fred Pollack. After working on the operational side for a few years, Fred said, why don't you come back and work with me on the investment side? And so I was already making that transition. We were then approached to go public through a SPAC, which we did as a firm, helped work on that, but then really shifted to be more on the investment management side. And so we have 175 investment professionals at our firm. We can talk about the different asset classes, but there's a lot of different moving parts and different strategies. And so there was a need to help kind of guide and focus some of those areas. And so I was doing that when my story shifts to sustainability. We had some large European clients who at the time came to us and said, Grosvenor has a really good history on the social impact side, particularly around underrepresented managers in private equity, which we had been a leader in, and doing some other kind of inclusive finance in state programs, which we can discuss. But there's all this opportunity around climate investing and energy transition and some other impact areas like healthcare and education and affordable housing. And so they really encouraged us to go build a dedicated team and hire someone to really lean into that. And so we looked around for a period of time. We hired a bunch of executive headhunters, and I sat in the room with John and Fred, the CIO and president. Didn't think anything of it. I thought I was just listening and part of this process. We were looking externally and we couldn't find exactly what we wanted. We saw that for large asset managers, there was a lot of failed models of taking someone from an NGO or the World Bank and sticking them on top and just calling them head of ESG, but that wasn't really leading to meaningful kind of change and investment dollars really, being directed in these ways. And so what we saw some of our peers doing, the big banks and some of the big asset managers, was they were taking a senior professional that knew the clients, knew the products, and had certain skills, and saying it's a newer space. If you're a quick learner and you have passions around it, you can be a good fit for that and really have a meaningful impact. And so we had one headhunter there. I remember he brought a list of here's the 4 or 5 things that we would assess any external candidate for this job. And as he started going through it, the first was investment experience. Can this person really get the respect of the investors inside of the firm so that they didn't just be seen as kind of an ESG or just talking carbon? They could really talk cash flows and multiples and understand what those people were doing. And LPs wanted that as well. They wanted someone who had that expertise. The second was around product creation. At the time, there really wasn't a lot of product in the private markets around this. And so could you come up with strategies that would lead towards capital being directed towards some of these thematic areas? The third was operational management. This was a brand new area. There was new compliance requirements from the SEC. There was reporting requirements. No one really had done impact reporting or sustainable reporting compared to financial reporting. There was data organization and collection, and how do you run track records on some of these things? And so the list kind of went on, and it was at kind of the end where, to John and Fred's credit, they turned to me and they said, you should do this. And I said, really? I've never done this before. And they said, well, you kind of have a great background based on your experiences for some of these categories. And we think you're a quick learner and it's an exciting growing space. Why don't you throw your hat in and try and build this? And so that's really where my story begins. And so I helped build basically a sustainable and impact investing team at Grosvenor.
So we're talking around 2021 right now. So that's about 4 years after you joined. And until now, I haven't heard the word sustainable, impact, responsible investment, or ESG in your background. What was going on at that point? It looks like a pivotal moment in your career, but was there something deeper that drew you to the space, or was it kind of a business opportunity because the top officers in your company are saying, this sounds like you, or was there something deeper there?
I think if we turn back to my personal story and my upbringing, I was always intrigued I had always done the philanthropic activity. I was involved on the junior board of City Harvest in New York in terms of fighting hunger in the city that had given me so much. I was involved in a bunch of cancer-oriented organizations, because of my mother's experience. It was only at that point that I saw the opportunity to blend the two. It had, and I recognize I came from this very differently than a lot of other people. But what actually intrigues me to this day is I am really excited by the idea of trying to prove out that you don't have to choose between performance and purpose, that capital can really do both if done in a commercial sense, and that these can really be complementary, not competing outcomes. And so that's really become the kind of mission that's really driving me. And so again, unlike many of my peers who come at it just from a impact investing passion side, I think I have some of that, but I also come with it from a real my belief is that the only way that we will get scalable amounts of money towards some of these critical themes is if we can prove out to institutions that the returns are commensurate with what you would get in those asset classes. And so at Grosvenor, that is really what we are trying to do. We are trying to build track records and proof of concept across a number of different thematic investing, impact, or sustainable strategies that show that you can actually do both and it can be complementary if designed in the right way. And so that's what really is my passion.
You mentioned some European clients were asking Grosvenor to develop a dedicated team. That seemed to be the impetus behind this. Can you tell me about any of those early conversations and what those clients were looking for?
So I was fortunate in that when I started building this team, there were a lot of really important foundational components at Grosvenor that we were far ahead of many of our competitors on being a good fit for this. First and foremost, over 70% of our business is custom separate accounts. I really believed, and we as a firm believe, that it is a great way to implement through a custom account if you are large enough as an institution, because what it allows you to do is it allows you to decide as the client, what are the areas of impact that you really want to focus on versus us as an investment manager showing up and telling you, here's a product and this is what you need to do. And when I first got involved in this, which was even kind of pre-21 when we first publicly launched it, most of the product in the market was quote unquote an impact private markets fund that did everything. It did healthcare, it did education, it did climate, it did all sorts of things, and it was all mushed together, and you were buying just an off-the-shelf impact fund. The market has tremendously evolved at this point, where I don't think that's exactly what things look like today, and it's not how LPs want to buy. And then GPs have now built up with specific expertise that allows us to thematically guide money. But so that core DNA of Grosvenor, which was around customization, which is something we've done for over 50 years in alts, fit really well with this concept. The other thing I'll say is, again, they saw us being a leader in certain areas. So we've put, over $10 billion with underrepresented managers in private equity. In 2003, before the term ESG even really existed, we were doing inclusive finance programs where we were basically working with local states in the US to create programs in private equity to drive job growth in their areas through investment and also tax revenue and business activity. We made our first renewables investment back in 2007 out of our infrastructure group. And we had done many healthcare and education investments that were really impactful, but when people were really talking about the word impact. So my challenge and opportunity was taking these strong components and foundations and really, how do you organize this activity and how do you really build upon it? And so that's really, I think, what these European clients saw. And they saw a desire on their side to really lean in and be able to find a manager that they were comfortable with who could then help them go further and further in that area.
You were building out and embedding a new sustainability focus within a large established alternative investment firm. I imagine there were some skeptics that you had to convince along the way internally.
Yeah, look, I think in any organization, you're going to have your, friends and supporters, and you're going to have your skeptics. And that exists even to today, having done this for 4 or 5 years at this point internally. I would say what I always kind of coach our team, and I'm a true believer in, is the most effective way to create change is for our clients, the limited partners, to tell our teams that this is important to them. It's something that they want to get us to get smarter on internally and really build programs that are dedicated or focused on some of this stuff. And so it is much more effective for a client to go and create a program, and then our teams really start to work on it, and it just becomes embedded in our business, and they build the expertise in partnership with us versus us going and saying, hey, you need to start to adopt X, Y, and Z. We obviously in the beginning had to do a little bit of both. Again, there was a lot of internal education. There continues to be a lot of internal education. We want to serve as a resource for both clients, but also the investment teams to learn best practices. As you know, in this world, there are constantly new frameworks coming up. There are new standards. And so picking through what makes sense, what's likely to be adopted by our investment professionals in partnership with us versus what goes too far or what's not substantive. And so we spend a lot of time thinking about that. And then I would say a large part of my job, especially in the beginning and continually today, was to broaden the investment funnel of what I'll call investment opportunities at Grosvenor towards these thematic, sustainable, and impact investment areas. So whether it was meeting new impact funds, whether it was sourcing new impact deals, co-investments, single asset secondaries, direct deals, our team really serves a very important function at this point of bringing a lot of new volume into the system and focus that didn't totally exist naturally. You would still get some of it in certain places, but I think we've really been additive on the investment side to really widen the aperture of the types of sustainable opportunities that are flowing through the system that are, opportunities for our clients to, invest behind.
Why don't we get into Grosvenor, give a high level picture for Grosvenor today for people who aren't familiar with the firm. Obviously, it's not a pure impact sustainability play. So we'll focus most of our conversation on that bit, but I'll paint the big picture first.
Sure. So we are not the Grosvenor in the UK, the real estate company. So that's the first place to start, which we often get confused with. We are an alternatives only asset manager. So what does that mean? We've been around for 50 plus years. We actually started in the hedge fund space. And this was when hedge funds were really non-existent as an investment asset class for institutions. And so Michael Sachs, our CEO, really the genius he brought to it was finding both on the investment side as well as on the operational side ways to get institutions comfortable with this new asset class that was growing rapidly, but was different and complex than traditional equities or traditional bonds. So that's really the history for a long time. Today at Grosvenor, we manage $82 billion of capital. About 23 of that is on the hedge fund side, and that is really the legacy business. More relevant to the story and where I focus my time is really our private markets business, and that's really where our business has shifted over the years. So in 2014, we bought the Credit Suisse Customized Fund Investment Group, which had been investing since, I believe, 97 or 98. So they also had a long track record of helping institutions in customized solutions invest in private equity, infrastructure, real estate, and private credit. And so we were hearing from our clients on the hedge fund side that they really liked working with us and partnering with us, and that we should broaden the asset class exposures and activities that we were doing. All pre my existence at Grosvenor, they found this great fit with this customized fund investment group at Credit Suisse, which came under our hood through an acquisition. What that meant is, fast forward to today, we've had tremendous growth on the private market side. So as I said, it's over 2/3 of our business at this point. And if we focus on those four asset classes, private equity, infrastructure, real estate, and private credit, we really do three main activities. So we are a primary fund investor. So we help people find, source, and invest into third-party managers. So it's an open architecture system. These are not Grosvenor funds. These are best-in-class kind of managers around the world, and it's really a global practice. Today, just to show you the scale, in private equity alone, we've invested in over 400 to 500 managers. So it's a very large scale operation. Over $40 billion of commitments have been made in private equity alone. And obviously we have these other asset classes. In infrastructure, we've invested in 100 unique GPs. So fund investing is kind of the core foundation. We also, though, and where we've really pivoted over the last handful of years, is we realized that there was an opportunity based on being a very important partner to those managers to move upstream from a value add perspective and really become a deal partner. So we have dedicated co-investment teams where we are often the largest or one of the largest minority investors into an individual company. So today in private equity and across private markets, we probably have 250 to 300 companies that we have substantial direct ownership into alongside a manager. We also have dedicated secondaries capabilities where we will go into the market and buy secondary stakes, both traditional kind of limited partners that want to get out and sell kind of an interest in an illiquid fund, but also now single asset secondaries, which look very similar to co-investments, directly investing into a continuation vehicle or a single asset in a different structure. And then I would say the smallest part of our business, but it does exist and it's relevant to the sustainable and impact investing, is we have a direct infrastructure practice. So we are a direct infrastructure investor, and we actually do that through the impact lens of labor unions. So we've always had a very large labor union, Taft-Hartley client base, who years ago came to us and said, we'd love to start to invest in infrastructure as an asset class, but we'd like to do it in projects that are not only making really good returns, but are also really helpful to the labor union ecosystem, creating jobs, creating new projects. So we have a dedicated labor team who looks at all these deals alongside our dedicated infrastructure direct team. And together, those deals in those funds have to meet both standards. And so we have almost $2.5 billion committed for that specific strategy, which is really an impactful strategy at the end of the day.
What percent of your AUM overall is sustainable or impact related?
Just to step back, as I said, we're built a little differently than a lot of our peers because we aren't a big, what's called a commingled shop. So today, over 70% of our business is these custom separate accounts. So building something bespoke for a specific institution where their specific objectives and their specific constraints are all that it matters in that. And so I like to say we have a very wide investment funnel. We tell our investment teams to go find the best deals out there. Lots of different things. Those could be sustainable. It could be small emerging managers. That could be just investing in a great European deal. It could be all sorts of different things. And then we have a very well-built portfolio allocation process where when any new client comes to us, we build into our legal documents and our portfolio construction what exactly are the objectives and constraints of what they're looking for. And those can be financial objectives and constraints. Those can also be non-financial around impact. What that means is that we are very much client-centric in our definitions. And so we need to be very flexible because, as you know, in this world, different people use those words in very different ways. So in the broadest umbrella of people doing something that has a sustainable orientation, we've actually invested $28 billion of capital into that. That includes our underrepresented managers, which if you go to a place like Europe, hasn't really been considered as part of sustainable or impact. But in certain other worlds, that's a huge focus for them historically. If you narrow down to a probably tighter definition, because we tag and evaluate all of these things to an impact definition, that's going to look more like 8, maybe 9 billion. As you can imagine, our infrastructure practice, which is our fastest growing practice today at about 16 billion of AUM, about 40% of their commitments over the last few years have been around energy transition and energy. And so we are doing everything from renewables to sustainable transportation to sustainable agriculture to waste to energy. You know, it's a very wide range of different sustainable data centers. So infrastructure and climate make up the largest portion of our impact kind of AUM. But we've done a ton in health impact and really looking at, okay, is there clear measurement? Is there clear additionality to what they're doing? We've done over $1 billion of health investments that are impactful. Everything from investing in businesses around extending dental pediatric care to rural LMI locations to, there's just an assortment of things there. And then we do things, as I said, in education, affordable housing. That's really how we define the broad tent of sustainable and impact. And then as people get narrower and they're more defined in their definition. For our impact only programs, that's going to be a smaller kind of lens of investments that would qualify.
But overall, you're looking after sustainable and impact investing. That's roughly how much AUM?
Yeah. So again, historically going back over time and looking at everything, we've put about $28 billion of AUM across all of those. Our underrepresented managers activity, because it existed before and was so scaled, so that lives in our more small and emerging, just general private equity practice. So I would say my particular kind of oversight or involvement would be somewhere closer to that 10 to 12 billion, I would say.
So it's as much as roughly a third and maybe tightly defined less than that. And just for people to get in their mind, your clients are institutional just almost the whole way, right? Pension funds, sovereign wealth funds, endowments.
Yeah. So 90% plus of our clients today are big institutions. As you said, pensions, public pensions, corporate pensions, sovereign wealth funds. That is the majority of insurance companies. We have a growing retail kind of distribution and practice. For what I do, it hasn't been huge yet, but for instance, we just brought on a program this year with $2 billion family office and foundation would fit in that world. And we're doing more because, as you know, sustainability and impact investing is particularly prevalent in the high net worth kind of family office space. And so I would imagine for our practice, we will continue to do more there, but Grosvenor as a whole, very institutional. To create a separate account, typically we need about $75 million of committed capital deployed over a 3-year period. So that is not something that all institutions can do. If you're looking as an institution to do $5 million checks, that's where commingled funds do better. We have some of them. So that's somewhere where we can take $1 million check from a union versus a $75 million check. But the majority of where I focus is more on the separate accounts, which is, again, over 70%. And then the last thing I'll just say is that it's a very global business. So about 45% of our client base is outside of North America. Very big in Asia, growing amount in Europe. And then, we have business obviously in Australia and Canada. We don't do a ton in the Middle East, although that's an area that we're focusing on expanding. And we don't really have any Latin America client base.
What is Grosvenor's mission and theory of change? At this point, I want to talk about specifically sustainable and impact investing. And what are the problems that you're trying to address and the deeper change you're trying to create in the world that we would say traditional asset managers aren't addressing? And how does all this apply to the alternative space?
Yeah. So again, because of this custom DNA and orientation, everything really starts with our clients and what are their financial and sustainable or impact objectives. So when someone comes to us, we definitely have our own theory of change. We have fundamental views on what qualifies into certain buckets, but we also really partner with those institutions to really make sure that it's aligning with what they're looking for. Ultimately, our goal is to create programs and have a broad enough kind of investment opportunity base where when someone shows up and wants to direct private capital into certain areas where there's positive, measurable, additional kind of environmental or social outcomes while driving a returns first market rate approach, we can satisfy those programs in the asset classes that we are in. So we are not a broad consultant that says, give us your whole portfolio and we'll do public markets and traditional fixed income. We're really laser focused on those areas. And so typically people come to us in one or multiple of those asset classes and they say, hey, we really want to focus on climate change and climate solutions, and we want to do it across infrastructure and private equity. Can you help us formulate what a program would look like? What is the types of opportunities out there? What is the return profile? What's the investable universe? And so that's really around the theory of change. I would say some our clients are at different stages of evolution around this. So some, like an APG, would be incredibly developed in their theory of change and what they want to do on the impact side. Many others are still evolving across the spectrum of sustainable investing to impact investing. And so what we try and do is we try and meet them where they're at, because again, that program is built just for them. It's not built for a wide audience. And so for us, we ascribe really to the gin. We really look for, when we're building our due diligence frameworks and assessment, we're really looking for that intentionality, additionality, and measurement. We are then really looking to drive proactive thematic sourcing across different asset classes and themes so that we give a wide array of opportunities for clients. We spend a lot of time around enhancing and collecting data, KPIs, both pre and post investment, both what I'll call custom KPIs that really tell a story around the outcomes and the impact, the targeted impact, but also some universal KPIs so that we can roll it up at a portfolio level and make sure that we're delivering holistically across a number of investments towards that theory of change of what that client is looking to do. So we're part of some of the standardization efforts of the ESG data convergence initiative and things like that in the industry. But we do really believe for impact that the custom stories are really often more meaningful than the universal. And then lastly, we work either directly with the companies or with our GPs to try and continually increase engagement around some of these topics, as well as with industry bodies on material issues when appropriate. And so, as you can imagine, as a minority investor directly into this stuff, typically we're working through a lot of our general partners who are the majority investor. But obviously, if that's an impact manager, they're caring about a lot of the same things we are. And when we're investing for an impact program or a sustainably focused program, we want to make sure there's that alignment and that engagement is happening, that there's 100-day plans around sustainable themes or opportunities and risks. And the one thing I want to make sure I say here is that, again, putting my investment hat back on, the thing that always has excited me about this area is trying to show people the opportunity set of returns and impact outcomes and not just talk about the risk mitigation. It's why we don't love the word ESG. We can talk a little bit about that. We don't really use that. But to me, when you invest in any company, you're looking for material opportunities and risks. And so what we're trying to do is change the conversation a little bit. To me, it's like, how do I convince these institutions that care about this, but they also see this as a unique, differentiated opportunity set in these asset classes to take advantage of opportunities while still always using it as a risk mitigation tool where needed as well.
In doing my homework, I identified 4 core pillars or areas of strategic focus. It's climate and energy transition, social infrastructure and essential services, labor and workforce impact, and then the diverse and emerging managers, which you've referred to a number of times. Can you briefly explain these to me, and how did you land on these 4 areas?
Some of them, again, naturally developed. So let's start with climate and energy transition. As you know, there's a lot of demand out there, particularly out of Europe, but now out of many global areas and in certain parts of the US from institutions that see that as an interesting opportunity set. What I think is most instructive or interesting about energy transition is that, for instance, in infrastructure, if a client says nothing to us about climate and they just want a broad, diversified infrastructure program, whether it's us or Macquarie or anyone out there doing it, energy transition has just become a mega theme and a mega kind of sub-asset class opportunity. And it has a very long track record going back well over 10 years of driving very compelling returns with infrastructure type, characteristics to it. So I would say the large amount of infrastructure kind of energy transition, climate solutions types of investments that we've made was very natural because it was very embedded in the asset class. And I would say we've just leaned into it further. I would also say our infrastructure capital happens to be heavily weighted towards European clients. And almost all of them at this point have moved to a place to really either focus their programs on that opportunity set or have it be a core component or integrated into it. And we can talk about one that we're launching right now, which was a very interesting story of how we partnered with an existing client out of Switzerland who particularly wanted to develop a net zero climate solution in infrastructure because the corporate board had come up with a net zero target and they wanted to start integrating it into the pension. And so We, for instance, in that built a custom definition with them of what would fit into that program. And we did a lot of work looking at third-party frameworks around net zero and ultimately broadened it to climate solutions because they didn't want just climate neutral things. They wanted also solutions for harder to abate areas. And so it's a great example of how we would partner with someone. So climate, to your point, big opportunity set, naturally started in infrastructure. What we've done and what we've seen is that climate has become an opportunity set across all of our asset classes. So in private equity, probably in the last 5 to 7 years, we've started to see dedicated climate-oriented private equity strategies and managers out there. And we're seeing deals that have real climate solutions to them all around services and products versus the hard assets that you would see in infrastructure. And we're seeing what we would call a hybrid, where there's a gray space where some of these things could be called infrastructure or private equity. So we now have clients who are coming to us and saying, we want energy transition or climate, but we'll give you the flexibility to go figure out where the best opportunities are versus necessarily just picking an asset class. We also, and we can talk a little bit about this, think that credit is a really interesting area of climate. If you look back over the last 10 years, there's been about $650 billion of capital equity raised for climate equity funds. If you look over that same time period, only $50 billion of dedicated climate credit has been raised from LPs. For anyone that knows capital structures, that's absolutely backwards. And so we think that we are starting to see growth in a niche opportunity set of private credit of people who specialize in this. And we can talk about, if you're interested, we did a really, really cool deal with a manager out in California who's an expert in residential solar financing and taking these really attractive kind of what almost look like residential mortgage-backed securities, but all related to solar, and then securitizing them in the market. So expanding into credit. That's climate. And climate, obviously, we all talk a lot about. What you called essential social services was something that we branded because we were seeing people who were interested in programs around to drive impact for certain communities that were often kind of connected. So we often see people come to us and say health and wellness, education, affordable and workforce housing. These are often themes that are kind of bundled together in some of our programs. So we ended up saying we branded that as essential social services. And we see a lot of activity out of our real estate practice for the affordable kind of workforce side. We think the returns are really compelling there. That's naturally happening now. It's become a very popular topic of late. And then we've consistently just done a ton in health and wellness and then education, periodically from time to time. So that is a big category for us. And again, in a custom solution, we have some people who will pick, okay, I want climate and I want social. So I want climate and health, or I want climate and education. So it's all about creating a mosaic of what impact outcomes or thematic areas they want to focus on. And then us having enough broad deal flow and capability to say, sure, this program's just for you. We can put that together. To your point, we've talked a lot about the underrepresented managers. We've put tremendous capital into that space. There is obviously a lot of change going on there with the Supreme Court and the administration in the US, but that's still an area that we think is attractive and we have expertise in. The last area that you mentioned around our labor and workforce, we talked about a little bit earlier, but that's been an area where we've seen this really interesting opportunity set, particularly around infrastructure. Not to say that it can't grow to other things, but again, to your point, that was an organic growth out of our client base and who they were. So that's kind of how we've gotten to the themes. Some are very organic to the asset classes. Some are organic to certain client bases or what they wanted. And others we've kind of developed over time.
You operate under a strict non-concessionary principle. What does that mean in practice for your strategies, and particularly in the context of balancing financial performance with environmental and social goals, for example?
So it's not to say that we couldn't take on a concessionary impact first mandate, but we haven't yet. And the reason we haven't, again, going back to my earlier point, is that we really believe for very large institutions that have a fiduciary duty, often to their pensioners or other people, that the way to really get scalable change and outcomes is going to be that they need to be able to represent that it's an interesting investment opportunity and competitive with the quality of what they would do naturally in those asset classes versus what Bill Gates is doing, for instance, and willing to take a certain lower return. So that has always been our approach. And so the way we've built our system is very intentional around that. Some people in firms like mine, we are not built to basically source and underwrite and execute and do everything ourselves inside of a silo, because we believe that in order to encourage that returns first and make sure that quality bar is being met, it needs to be part of the broader funnel and system of investment opportunities that we're seeing out there. So in healthcare, maybe we have a healthcare impact manager, but they need to stand up on their own compared to any other healthcare manager that we're looking at in private equity, for instance. And so what we've really done is we've taken our current pipes and teams and practices, we've layered on additional types of frameworks and measurement and assessment. We've brought in expertise into those teams. So I like to say that I have a dedicated team, but the team is really much bigger because we have what we call sustainability and impact leads embedded in the regular teams. And so we partner with them on a day-to-day basis. We're looking at deals together. We're talking about frameworks. We're talking about measurement. We're talking about engagement. But at the end of the day, they're really the ones that are pushing a lot of this activity and skill set into the broader teams of 175 people. That's really our belief. And so because we build that system like that, it goes through the same investment committees. It's not built for an impact first approach, truthfully. It's built intentionally to really be returns first, market rate. If we wanted to take on something that was really impact first with concessionary returns, we'd have to kind of change our model or do it a little differently than we do today.
Do you feel like there's a place for impact first in the world? This is a concept that I struggle a little bit with the different people I speak with on the show, because I've always felt we're never going to get anywhere if this isn't a better way to invest. I always say no one ever had to stand up and convince anyone that getting a higher return was a good thing. You know, you didn't have to have slides and slides to show that. And with all the talk on ESG, and people are saying that reduces your risk. Well, if it does reduce risk, then in the long term, the returns ought to be better. And then we'll have no problem mobilizing capital. I think everyone is all ears and open to investing in a new way that long term yields better returns and more impact. There's a number of people that I've spoken with that do feel that the risk with this is that all the capital goes in certain types of places like climate. A lot of people say there's overcrowding of capital and mobilization of capital to climate right now, and at the expense of social.
I believe that in order to make like scalable, impactful change in some of these thematic outcomes, the only way to do it is to make investments that are competitive with any other investment that's out there. I believe that, and this is my personal view, not necessarily Grosvenor, that all good investors, all good direct investors are taught to look at any material risk or opportunity. The concept of ESG is really embedded in just looking for what are the biggest factors that I need to take into consideration to make sure that my risk adjusted returns, are what I want them to be. That's basic foundational kind of risk mitigation. Again, where we really get excited is that we think that some of these are mega trends, and there are huge needs in the world, and that there's opportunities to actually differentiate into different strategies to create not only financial value, but also, impact outcomes around environment or, on the social side. And so I agree with you. I will say, I still do believe there is a place for impact first investing. I just don't believe that that's going to be the scalable way that we will get pensions or large institutions to invest. I think that when you go to the extreme side of the innovation curve, what again, Bill Gates is doing with breakthrough ventures, they are looking to basically find the next greatest thing that breaks kind of the model. And I think that, it's great to have some of that capital that's willing to do that. But again, eventually all that technology needs to become scalable and it needs to become institutional grade, and the returns will need to be there. So I'm not against if people want to put some capital into things as foundational and not necessarily have that. But I don't believe that's going to lead to scale over time. That's, to me, is like the innovation more around it. And I will say, even something like climate, to your point, we see cycles in this. And so, for instance, if you take the political environment in the US right now, our team didn't particularly think that renewables and the return profile of them over the last, year or two in the US was super attractive. We obviously found our spots, but generally it wasn't an area that we were super focused on. Fast forward to today, I was with our head of infrastructure in the US, and we're seeing super interesting wind farm deals in Illinois for existing assets because capital has run away from that area. And so I think that with all of these things, we obviously all know what's happening in the venture capital world of private equity around climate. There needs to be a lot of fresh new capital to come back in, and there will be cycles. And so, like any good investor, these themes will go in and out of favor over time.
You've mentioned about over 70% of your business is in custom, separately managed accounts rather than commingled funds. That's somewhat unusual in the industry. And I think you offer what you call a Chinese menu approach. Don't know what your Japanese and Korean clients think about that, but maybe you could walk me through your client engagement process and how all this works, starting from what you might call your first sit down with them in a values discovery process all the way to portfolio implementation. But I want to understand ultimately how you go about translating a client's abstract sustainability and impact goals into a customized, measurable investment strategy and concrete portfolio allocation.
Yeah, so I think as we talked about, the discovery phase of really understanding in partnership with them what they're looking to achieve is like the critical first phase of any engagement with a client. And again, that stretches what are their values? What are their financial or thematic impact priorities? Do they care about climate? Do they want to focus on healthcare or education? Do they want to focus on place-based investing? All of these types of things. And then really moving into the design phase of how do we co-create together a theory of change? How do we map that investable universe across, both if it's on the deal side, one of the things that we think we do really well is we actually can look at, so if a deal comes from a non-impact manager, someone we would call a generalist, but the deal itself is clearly impactful. So the company is clearly impactful. We actually think that for many of our programs, and this is something we talk about with them, they're comfortable with that being an impact investment because we're only investing in that single company. And so if we can get the measurement and believe in the engagement and the profile of that company fits, it's a really effective way to widen the investable universe and really, again, work to make sure that you're looking at the best quality and the best risk-adjusted returns out there. So we look at, okay, we've discussed what are you focused on? What's the theory of change? What's the asset class? What's the return profile? Now let's give you our experience at Grosvenor, bringing in the experts. What's the investable universe look like? What have we done in that space? What's worked? What hasn't worked? Are you too narrow? Are you broad enough? Is it commercially viable? We do not want to create a program that is so narrow. For instance, we can't create a separate account putting to work $75 or $100 million in plastics in the ocean by itself. It's too narrow. And we'll tell our clients that because it doesn't serve us. We really believe we're partners at the end of the day. We sell ourselves as an extension of staff. They can't do everything themselves. And so we try to be complementary and we try to be used as a sourcing, an execution, a portfolio manager to them. And so in order to do that, you have to be very open and honest of what's deliverable. All of that gets translated into a portfolio construction, right? That goes back and forth with the client. How much do you want to do in, growth versus buyout? How much do you want to do in X asset class? How much do you want to do in themes? Let's go into sub themes. Okay. In climate, like, do we want to focus on sustainable transportation and waste and water management, or do we want to just broadly focus on climate? And we talk about what are the reporting and the KPIs that come out of that. Does it meet the client's needs to meet their impact or sustainable bar? What are their exclusions? Are they comfortable with nuclear energy, or are they not? Or are there certain things, are there certain frameworks that need to be built in? So all of it, again, in the design phase and the portfolio construction, is really taking that discovery, understanding how to build a bespoke portfolio that really meets their needs, while doing it in a way that our teams have signed off that we think we can do a really good job and deliver a returns first portfolio while driving these other things. And again, as you can imagine, definitions and how sophisticated vary tremendously across client bases. And so some we are teaching a lot, others are telling us what they really want, and they know exactly what they want. And so we have to be able to be nimble across that. And so then we go into implementation phase. We deploy that capital across that portfolio construction in the different ways. So maybe they want to do it across primary funds and deals or co-investments. Maybe they just want to do deals. They do their own funds. That's fine also. When we're doing that, we're aligning with things like SFDR in Europe. We're doing it with Iris Plus and the UN SDGs, the EDCI. What do they care about? You know, back a couple of years ago, it was like, I only want to invest in a PRI manager. Now, today, everyone's basically a PRI manager. And so it's like, okay, maybe there's a better, methodology of like, what is a sustainable manager? It became SFDR 8 and 9. Now we're thinking about, does SFDR 8 qualify, or, is 9 too constrictive? So we stay on top of these things and we're in the market. And so we can be really good kind of knowledge partners, both internally and externally. We work with a firm called Dansmead in the UK, and they're really our enterprise-wide sustainability consultants. And, we're talking to them all the time about some of these changes. We're talking to European lawyers around SFDR consultations, things like that. So all of that goes into the investment phase. And then I would say post-investment, it's the client interaction, meeting with them, telling them, what does the pipeline look like? What have we done? What's the financial profile and stories of these companies? But what's the impact orientation? What's the goals? What's the outcomes? How are we monitoring this? Are they achieving it or not? How do we, rate how we're doing or how these companies are doing? And so, we have really lots of different ways that we've kind of implemented with different people. And that's why we use this term sustainable and impact investing, because we really believe it's a spectrum where people come in to that.
Give me an example of how you've tailored a program to a client-specific sustainability goals.
We have a client who is a family office foundation in the US. They had invested in private markets and private equity predominantly for a number of years after he had sold his business. It looked like the generalist managers you would expect. It was the Blackstones and the Leonard Greens of the world. When he passed, he had very deliberately planned that he wanted to move all of this capital into an 100% impact orientation. He had decided what core thematic areas and outcomes he was focused on. So particularly around health and wellness and education, affordable housing, particularly as much as possible, benefiting low and moderate income areas in a certain region of the country that they had really spent a lot of time in building this business. So we basically partnered with them. It was a 1 to 2 year discussion before this became live, of going back and forth, as I said, on what could this conceptually look like? How could we be an extension to your team and staff? Originally, it started as maybe we will help you go find impact fund managers. Then it became, we're going to do that internally, but maybe you can softly help us with that, and we will have you be the deals partner for us. So off of the 400 to 500 managers that you see deal flow from, if there are deals that meet the impact subset, or you can go out and source, let's put together a custom portfolio of 15 to 20 deals over 3 to 4 years that provides diversification by manager, by vintage year, by sub theme, but all basically aligns to that theory of change of what they're doing with custom impact reporting that would tell the stories of each of those investments and how they align to that impact approach. And so this is a program that we are working on right now, and it's very collaborative. We have meetings with them and we talk through deal flow, and they tell us, okay, this doesn't meet our bar because of X, Y, and Z, and this does. And our job, again, is to really get to know that client in the beginning, even in the early stages of deployment. And then I think once we get to a place where it's really clear what fits, what doesn't fit, really go out and portfolio construct something that meets their needs. And so that's an example of one program. I would say the second one, which I mentioned a little bit earlier, which I think is really interesting, is we had a very large infrastructure client who had what I would say a softly European climate bend to their first program with us. When they came back for the re-up, they started talking to us about net zero and climate solutions. Over a whole year, we studied basically with them in partnership, what are the best ways to implement? What are the net zero frameworks out in the market that we would want to ascribe to or build custom definitions off of? We ultimately, changed some of their views based on that. And then lastly, worked through developing a custom impact definition and solution for them that really met their needs. And so I think these are two examples of, again, that custom partnership and development that can then be, deployed on a discretionary basis.
Your approach for achieving impact and sustainability, are you projecting that and quantifying that as you go in? Or is this something you create while you're investing? I haven't really heard you use the term engagement so far. Do you ever invest on something that could be good, but isn't today, but with engagement and influence and management, you go from brown to green?
Yeah, so we do a lot of brown to green. We have had a lot of success with taking areas like data centers that have very, high kind of carbon profiles and looking for solutions of the future that are better kind of mousetraps of dealing with energy and net zero. And for any of these programs that we're talking about, we are definitely upfront before we go into any investment, assessing the impact, making sure that it meets the theory of change for that client program and that it hits a certain bar. Now, as you're kind of suggesting, it doesn't always go as you hope when you have hundreds and hundreds of investments. And so that's really where engagement really, for us, we do engage with the GPs up front to make sure that our partners have similar theories of change and focus and mindset. But a lot of the engagement really comes in flight, as you suggest. So when things don't go exactly as planned and there needs to be changes, we've had, companies that have had, unfortunately, like worker fatalities or different things where we sit on the board of a number of companies and we sit on the LPAC of a lot of funds. And so in certain situations like that, we work with them to make sure that new safety protocols are put in place and that changes are made. Our managers, because we have so many, are at very different stages of their life cycle in terms of carbon measurement, in terms of how to measure avoided emissions, things like that. And so we partner with them on how do they advance kind of where they are. And again, when you're dealing with an impact manager, it's relatively easy because they, already are doing a lot of this stuff. A lot of the engagement often happens with the people who are very sustainably oriented or open to it, but don't necessarily have that as much in their normal course of business. And so I think there's a lot of engagement that goes on around 100-day plans, as we talked about. I'll give one example. We have a company that was dramatically changing their business. They were going from, I don't want to give it away, but they were going from one thing as a big stable business, but all of a sudden they built this massive backlog in EV charging infrastructure that if it had played out and they were able to monetize their backlog, the whole company would have been around EV charging. And so it was taking something that was one thing and becoming something very different. When the changes in the IRA came out and some of the administrative changes, a lot of the NEVI funding basically froze up for, financing a lot of EV charging in the US. And so they basically needed alternative sources of funding for this brand new unit where they had invested in a ton of people and were starting to roll out this pipeline. And so again, in our ecosystem, we introduced them to one of our credit managers who was looking at this and was interested in maybe filling that both as a return opportunity, but also to further that. And so there's lots of different ways of engagement, but I bring that up as it didn't go as planned. Like the plan was huge backlog over the next 3 to 5 years. It's the majority of revenue of this company, and like the ROI on all those projects looks great. There's a lot of employees. And then all of a sudden it went, oh God, like we went to a board meeting and they're like, we don't have financing for this stuff. We're going to have to just stop it. And so, there's a lot of ways where we partner with our leading GPs to try and help and engage in different ways.
I think I read that most of your mandates are discretionary. Is that correct?
A lot of our big peers have very large consulting or advisory businesses alongside discretionary. That doesn't mean our clients, again, in these separate accounts don't have a lot of say in what they do. They can have veto rights. They can have different things. But at the end of the day, they're really entrusting us as their partner, that we design that program up front that meets their theory of change, meets their objectives around sustainability and impact, as well as financial objectives. And then they're giving us basically the right to go implement that program on their behalf. Again, the ethos of our company is very much partnership aligned. So they can be as involved or uninvolved as they want to be. And there's different clients on that spectrum, but it is a discretionary capital business at the end of the day.
There's a lot of variation in semantics in this whole responsible investing business, but I noticed you're very deliberate about differentiating between sustainable and impact investing. A lot more people are using these terms interchangeably these days. What's the difference for you, and why does that distinction matter in practice?
I would say the biggest difference for us is really around the intentionality and the measurement. So on the intentionality, as you said, we happen to invest in a bunch of stuff with managers who are generalists that fall into areas that might be a thematic area that's, health, right? But we don't really consider that an impact investment. And then on the measurement side, we actually have managers who, it's funny, I meet a number of healthcare managers who have never even thought about using the term impact or calling themselves an impact manager, even though their whole ethos is built around how do we improve patient outcomes or patient care and improve the system. And they measure that because that's how, to be financially viable, these companies have to already measure it. And so we look to make sure that if we're going to call something impact, we're going to be able to measure. And that's going to be that GP is collecting the things that need to come out that are important to our clients for that. And then again, they can't have just like fallen into it. There needs to be some intentionality to it. So that's really the broad spectrum. I would say we don't call programs that just many of our programs have exclusions, right? We don't want to do X, Y, or Z. That's not in our sustainable or impact bucket. That to us is great and we're happy to do it, but that falls into a different land. This is really ones that fit the thematic areas that we're focused on. But again, to your point, there is a difference in terms of where the bar is at, and clients get to pick where they want to be on that.
You've said that the structure of private capital has better transparency and more ability to create change and outcomes. Explain that.
I come from obviously a background more in public markets. For the first 10 years of my career, I obviously started in banking. And now for the last 8+ years, I've been doing private markets predominantly. When you're doing hard things and you need things like measurement and you need engagement and you need to change, when you own a public company and you're a big institution and investor, you might own 2 or 3% of a company. And once in a while, they'll listen to you. You'll go meet them, they'll pay attention to you, they'll do some engagement. The reality is when you own the majority of a company, you're running the board, you're picking the management, you're paying the management, you're setting the financial and non-financial impact objectives for companies, and that's your company. Your ability to do stuff and really drive impactful outcomes, in my opinion, is very different. I honestly believe that's why most of our world started in the public markets, because people realized, oh, this is a hot marketing kind of saleable thing. Let's call it ESG products. They did a bunch of exclusions and different things, but they weren't really driving a lot of change, nor did the financial returns really pencil out. And so that world has gotten very complicated. And so I'm not sure what public markets, when someone comes to us in their pension and they're like, we're going to do this across our portfolio, it's doable. But like, I'm a big believer that your private markets control investments are really where you have the ability to direct kind of capital intentionality, measurement, all the things you really need. I think in the public markets, there was a very big trend towards so-and-so runs engagement for a big mutual fund or this or that. It was very hard to move the needle and continues to be, just because of the sheer dynamic of, they are very small individual investors. So you need to have management teams that are incredibly open to their ideas. And that just doesn't happen all the time.
You developed Grosvenor's approach to measuring impact across the different asset classes that you guys are investing in. And I know you participate in the ESG Data Convergence Project. All of this seems like it would be incredibly complex given the diversity of your portfolio. What does that measurement process actually look like, starting with due diligence to post-investment monitoring? And maybe you can first explain what Grosvenor's sustainable investing clients are looking for in terms of sustainability and impact outcomes. What metrics actually matter and what separates the signal from the noise?
It's not always the most satisfying answer, but as you can imagine, we have many separate accounts with many clients across the world in different regions who have very different standards. So if you asked me, our European clients need to report to regulators and care tremendously about measuring scope emissions and, the change in the carbon, picture. And so one of the core data components and KPIs that we do is we measure scope emissions from all of our individual deals. And then we also measure it for our managers using partners like MSCI and a firm called Reporting 21 out of France. We try and get actual collection from the companies, and where it doesn't exist, we've used proxy methodologies that are accepted in the market with partners to roll that up for them. We have other managers, again, or other clients who are very early in their journey, and they want to know what is the gender, ethnic composition of just boards or C-suites, or how many of my managers are PRI or GRESB, things like that. And so it's a very disparate kind of collection. What I will say is when we started our process, when we built our team, we hired this firm in the UK that I mentioned, Dansmead, and we really looked at what are all the best practices out there of data collection while still being reasonable, recognizing that every manager we invest in, whether they're sustainable, impact, or nothing, we want them to try and answer, and we want to encourage them to give us information. And so we've built a proprietary collection, both for initial due diligence as well as an annual monitoring process. We built it in conjunction with this firm, Reporting 21, which is now owned by Cordy in Canada, but was out of France, where it is a SaaS-based system. It's what we call our collection kind of ecosystem of all things sustainability and impact. And what it allows us to do is there's a lot of conditional questions. So we start high level with certain people, and then as they show us a depth of collection or knowledge, we get really deep. It doesn't really do us any good to ask if people are doing, temperature scenario analysis if they tell us they're really doing nothing around climate analysis in their strategy or their company. So the use of what used to be a paper-based survey that then went into online tool, which is very sophisticated. And so we look at, for managers, we look at the firm across a number of areas, and we look at the fund strategy across a number of areas. We also then, to the credit of some of our European clients, were encouraged to say, okay, you have a lot of people that do investments. If Scott looks at these answers versus John, are we going to come to different conclusions? Let's build some baseline. And so we built a scoring system that we call our recommended scoring system, and a rating system that comes out of it. So every answer that comes out of the system, if it's a qualitative question, basically leads us to a recommended kind of where do they fit on that 4-tier proprietary rating system. On the top, we have got financially driven impact and managers. On the bottom, we have people who have no integration. Now, as you can imagine, what I focus on, and for the programs that are sustainably focused, we're not doing anything with the people at the bottom half. We're only really working with the people at the top half, but we do have across our firm want to collect, to your point, from a risk mitigation standpoint and make sure that there's not factors there, a whole sort of different things. And so that's qualitative information and it's quantitative information. And again, for the impact stories, we want more custom KPIs. Okay. So if your theory of change is around bringing LMI, rural, areas access to certain healthcare or certain education, now let's see what is the relevant KPIs that you can share with us. And we're going to collect that from you every year. And that's what we're going to share with our clients in our reporting systems. EDCI, I think they've done a great job in creating a very simplistic, standardized, what I'll call broad sustainability. Let's collect some KPIs that we can roll up. That doesn't really check the box for a true impact mandate, but it at least gives us something to work with that we can and roll up carbon emissions or things of that ilk.
Is there ever the danger of a trap of measuring everything and understanding nothing?
Yes. And so that's why I think, again, we have two constituencies that we play to, our LPs and to our investment teams. We need to collect very material, important information for the investment teams to make sure that these investments are doing what they say they're going to do and have the proper kind of alignment with the theory of change and the measurement and all those KPIs. We need to do other things for our LPs who might be asking for a much wider kind of universal thing, because we might be one of many managers in their portfolio. And so they might want certain general statistics, PAIs, things like that, and just so that they can layer that together across their broader portfolio. So I think realistically, though we have a broad set of what we collect, I think for what's most useful for the investment team, it's going to be things that are custom to that business or to that company. I think for the LPs, it looks a little bit more universal, broad, so that they can hit different stakeholders, boards, pensioners, regulators, things of that ilk.
Is storytelling important alongside of quantitative KPIs when you're reporting to LPs?
Yeah. So I think particularly for impact programs, we spend a lot of time doing qualitative storytelling around what are we trying to achieve, what communities, what is the impact, what's the developments that have happened. So we collect a lot of that qualitative storytelling and then put that together for them alongside a couple of quantitative KPIs that support the narrative.
What makes for a truly compelling impact story that resonates with a returns-focused audience?
The best situations is when it's totally ingrained, where the two can't be totally separated. So as I mentioned before, if you are delivering a healthcare service and, access to certain communities is critical for the impact side, but it's also critical to the growth profile of the business. That's core to the thesis. When we can see those things intertwined, where if we weren't talking impact or, finance, and it was just, this was obvious in the story, I'd say that's the best things that we can find versus having to tell two separate things, if that makes sense.
I'd like to jump to the diverse and emerging manager commitment that you guys have. It's interesting. I think it's a fairly large commitment, and you've been doing this since 2002, long before this was something trendy. Can you define what you mean by diverse managers and how do you measure diversity?
It's somewhere around 15 plus or minus. Again, this is not my specific area of expertise. We have a dedicated team that focuses on this. Starting at Credit Suisse years ago, before Grosvenor even purchased it, they believed that there was an opportunity set investing in a very wide range of managers that looked and different, had different kind of sourcing channels, had different views of the world, and could basically bring different perspectives and create value through it. It was always a returns first strategy. As I said, the track records are very supportive that it was financially attractive and continues to be. And so it's really widening the net of who is investable. The definition was pretty simple and clear. It was that a third of the general partnership of a manager needed to be owned by a range of different categories. It's everything from gender to different ethnic groups to disabilities, veterans, things like that. So there was a clear definition of what would fit into it. and people either fit or they didn't. That's really how it worked. We just have a long history of working with institutions around small and emerging programs. So looking for small and emerging managers that create value, and our underrepresented managers happen to be a large portion of that and do very successfully. And so that continues to be a business that we believe in.
Why do you think diverse managers have performed better?
You're widening the investable universe. People are coming from different perspectives, different life areas. And even if you just think, if you're a private equity firm, where are you sourcing deals from? What is your network? Who are your relationships? What is the communities you grew up in that you see opportunity sets? And that might look different than someone else. And so I think just the breadth of what's out there, and then maybe the overlooked aspect of it, because of certain communities and networks, capital flowed to certain people easier. And so it's maybe overlooked. And so taking advantage of that to really find, small and emerging managers that maybe weren't, Blackstone.
You've inferred in our conversation about diverse managers as a US centric thing, and that perceptions of sustainability differ significantly in regions like Europe and Asia. Given Grosvenor's global footprint, how do you navigate these vastly different regional understandings and regulatory environments and cultural priority for sustainable and impact investing? And have you had to adopt a distinct approach in some specific non-US markets?
The way we do it is it's a global business and it's a global team. So as I mentioned, some of those sustainability leads don't sit in the US. They sit in London, they sit in different places. That is absolutely critical to getting localized knowledge and preferences of what matters, what people are focused on, what's changing. So again, there is no shortage of conversations, particularly out of Europe, being a leader in sustainable investing, for me to be talking to our team based in London, consistently. And then last night, I was on the phone with our team in Japan, and we're talking about climate and some of the things going on in climate for Japan, where the equivalent of the IRA that they put out for the government on a relative basis as a percentage of GDP was like multiples the size of the IRA. And not as many people talk about it. But so Japan's government has leaned a lot into climate investing all of a sudden. And so typically we see corporates and pensions and other people follow over time. So, I think the key is having boots on the ground, and where you don't have it, having really strong advisors or relationships to understand that. But that's the only way that we have 5 to 10 SFDR compliant programs. Obviously sitting in Chicago, that is not a huge focus for US managers, but as a global business where 45% of our clients and a lot of our deal flow, comes globally, you have to think globally and you have to be smart about that.
What's your take on the current ESG backlash? I think that's primarily in the US, but how do you cut through the political noise and maintain focus on long-term value creation?
My view is that a lot of the thematic areas that we've talked about or that we focus on at Grosvenor are megatrends that I don't believe will go away over political cycles. That doesn't mean, as we talked about, that capital won't shift over time and create opportunities or make things less interesting, where things get overheated. But I just think when you look at the global trend towards, what historically was net zero, I'm not sure that term is going to last much longer, but, there's so much, demand from consumers as well as from governments with commitments and corporates that I don't think one locality changing their, stance towards one of those things is going to mean that, climate change goes away. But it will impact kind of flows and opportunity sets in the short term. And to your point, what's interesting is that when I used to travel in Europe and we talked about our quote unquote underrepresented managers, practice, people would look at us like they didn't understand what we were talking about. And it was a very US centric concept. Today, all of a sudden, we're hearing more about it in Europe. We're hearing more about, it's more of a gender lens, but like we're hearing more for the first time out of our UK clients and different things, talking about this that never talked about it before. They might not call it diversity, equity, and inclusion, or they might not call it, underrepresented managers, but, it might be, different terms. And so I think things will shift, but at the end of the day, the need for improved access and quality healthcare, education, affordable housing and workforce, climate, dealing with the implications of mitigation and adaptation around climate change. I think they're mega trends that are going to last for long periods of time. And it's on people like myself and others in the industry to kind of keep your head down and keep doing the best you can, find the opportunity sets that are being developed off of it. And then basically when we come out of it into whatever the next political cycle is in the US or anywhere else, we can keep shifting with it. And I don't think this is the first time that's happened in this industry.
Do you think that this could actually be healthy for the industry by forcing more rigor and authenticity?
100%. I think that you always are cutting out people who were kind of on the edges, seeing it as a little bit of a marketing fad or weren't real believers. I've seen many of my peers, as well as us internally, really think about the language we use, how we talk about it, what qualifies, what doesn't. Anytime you have kind of a market that gets very hot and then, goes all the way the other direction to a certain degree, like there's very healthy kind of dynamics if utilized as an opportunity set.
What are some of the underhyped areas within sustainable finance or impact investing that you think holds significant long-term potential for both financial returns and real-world impact outcomes?
Two areas that come to mind. We talked a little bit about it, but the first is around this climate private credit, right? How do we create experts who understand project financing of proven climate technologies that maybe, an Ares or a Golub isn't comfortable doing? Or, how do we basically deal with this funding gap that will likely be there for climate credit? And so we think there's potential for equity-like returns with credit dynamics for the next few years because of this supply-demand mismatch. The second area I would say is climate adaptation. We're hearing this more from our clients. Despite being 80% probably of the problem, adaptation gets less than 10% of the capital. Most people are focused on the renewables, the mitigation, but we think there's huge potential in terms of investment into areas like water, flood defenses, HVAC retrofits, food resilience, and think that that's going to become more of a balance of where climate goes from what it started as.
Beyond investing in the energy needs of AI, how does Grosvenor view AI itself as a direct tool or solution for advancing sustainability and impact goals? Are there specific AI-driven applications you're exploring as investment themes?
I will tell you, I've never been a first adopter of technology. When I first heard about AI, I didn't give it much focus. Our team uses it all the time, every day. We believe that it is an incredibly powerful tool. We use it in all different ways. As you said, we're getting so much information and we're trying to figure out, okay, what really matters? What KPIs really exist in these 50-page reports from hundreds of people and all, if we're trying to craft stories, AI can be tremendously helpful in digesting that data. We use it in just lots of different ways. And I think Grosvenor really believes that it's an opportunity set for our business as a whole and something that we're leaning into.
If you could go back and give advice to that young man who lost his mother at 5 and was trying to figure out his place in the world, what would you tell him?
Well, I'm still trying to figure it out, but I will tell you that life is not a straight path. And even in my career, there have been many unpredictable shifts, and just keep learning, keep growing, take those opportunity sets, figure out where your passions are. Because if you look even in my 20 plus years, it wasn't predictable that a hedge fund direct investor would be leading a sustainable and impact investing practice in private markets. But everyone has their paths. And if you do a really good job and you take a mix of your passions and your skill sets, you can end up in places that you wouldn't expect.
John, I've got a few rapid fire questions for you before we wrap up. Don't overthink these and just give me whatever comes to your mind, or if nothing does, feel free to take a pass. That's okay too. What's the single biggest myth about sustainable and impact investing?
You can't actually earn strong returns and drive impact at the same time, that there isn't the ability for it to be complementary versus it being competitive factors.
What would you say is a must-read book or paper that all sustainable and impact investors should check out?
I'm on the LP advisory board of the Impact Capital Managers Association, and they put out a study with Morrison Forrester last year called Alpha and Impact. Really, again, looking at the value additive strategies. And, I often think of impact as, when done the right way, really driving improved productivity, cost efficiency, while also driving other outcomes. And I think that paper was really interesting, sharing it.
Name a sustainability or impact buzzword that you would love to banish for all time.
I got 3. ESG, which is the easy one. I just don't think it's how people really invest. We don't see people bringing programs together and shoving the environment, underrepresented managers and governance all together and calling that a program. I just think it's outdated. I think the investing with purpose buzzword is kind of overdone. And then the hot new one, which I mentioned and leave some controversy, is net zero. What is net zero going to be? Is that going to be a term in the next 5 to 10 years, or is it going to look a little different whilst people still have climate commitments, but maybe that wasn't the best, term?
You don't have to name names, but can you describe an investment you made that you were convinced of at the time? It ticked all your sustainability and impact boxes, but in the end, it didn't turn out as you expected. And what was the lesson learned from that experience?
I think the one that we discussed earlier is a good example, which was we saw this massive backlog, a company totally transforming. And then obviously there was an idiosyncratic event which pulled the rug out from under them in terms of, financing. And so we're very live in working through that. And I don't know what that is going to look like, but I think that's a great example of, you can get it all right on paper up front, but then you have to be able to adjust. And there's macro and internal and external kind of factors that always play into returns.
And if someone wants to get into the sustainable and impact investing space in 2025, in the near future, where would you advise them to start?
My background, again, being a little different, I think become a great investor first and foremost, and figure out how to then blend that with passions around impact investing, because I believe that we need more people who come at it from that angle so that we can scale and succeed, because I believe that you need returns and impact for it to really meet institutional demand. And that's really what's going to create the change in the world that we need.
John, I really enjoyed this. I want to thank you. We covered an awful lot of ground here today, and I appreciate you taking me through all of this. It was good to hear how you're applying all this in the alternative space. I learned a lot.
Well, I appreciate you taking the time. If anyone has questions or is interested in exploring this at an institutional level, we always love to have conversations.
Now tell everyone what's the best way they can find out about all the great work you guys are doing at Grosvenor, your website.
On our website, we have a section called Our Impact. It has everything from our impact report to our environmental TCFD strategy to some deal highlights. So I think that's a good place to start for most people.
So everybody go to GCM Grosvenor.com. And I'm going to spell this for people listening. It's GCM, and then Grosvenor is GROSVENOR.com.
Correct.
So GCM, GROSVENOR.com. Lots of good information there on their sustainable investing platform. So
thanks so much, Scott.
All right, Jonathan, thanks again. All right, goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, SRI360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.